Welcome back. You're watching The Firm. In 4 months, 4 Indian companies have announced ADR programs. That's more than in the last 4 years, I think. So what's prompted this sudden interest in ADRs? Well, if you're a regular viewer of The Firm, then you probably know the answer already. It all started 8 months ago when the government announced a new depository receipt scheme. That allowed for the first time the establishment of sponsored and unsponsored level 1 or non-capital raising depository receipts on the back of Indian securities.
So historically in the Indian market prior to this new regulations coming out, the only DRs which are permitted is what is called as level 3 or capital raising DR programs, where Indian companies had to list themselves on overseas exchanges, they could raise capital, bring it back into the country. What the new rules do are enable level 1 or non-capital raising program. Essentially, it allows overseas investors to trade in Indian companies via the secondary market using a DR mechanism. The second key change is that under the ambit of level 1 DRs, there are 2 kind of DR programs which are now allowed. One is sponsored and the other is unsponsored program. The key difference is that in a sponsored level 1 program, the company appoints one depository bank which runs with the entire level 1 DR program. Whereas in the case of an unsponsored program, the company has no involvement and multiple depository banks can start trading ADRs in the secondary market of the company simultaneously. So that's the key difference between secondary and the unsecondary. So that was the second change. The third change, Menaka, is that the new rules allow for issuing ADRs overseas on underlying other than equity. So underlying instruments like government bonds, corporate bonds, mutual fund units, they're all allowed for floating ADRs against them. So that's the third key change.
Within a month of the depository scheme being notified, global depositories had filed to establish unsponsored level 1 ADRs for over 160 Indian companies. But if an unsponsored ADR is established by investors, then a company can do a sponsored ADR only on its termination.
From a company point of view, I think, I wouldn't really call it as being a cause of concern, because the reality is that, once this new product goes live, unsponsored programs will be a reality. So even if the company does not want, the rules will allow different banks to start doing ADRs in the secondary market without the company's involvement. So I wouldn't really call it a cause for alarm. I think there are pretty valid reasons for that. I think, yes, what companies can do, and some of them have done, is to take a strategic view on whether they want the market to lead this whole product via unsponsored route, or whether the company want to play a more active role and going for a sponsored program.
I think a sponsored level 1 ADR makes a lot of sense for companies that want to provide its investors the opportunity to be able to trade in the US and be able to exchange shares there. So, from a perspective of providing liquidity to its investors and increasing its visibility, and as a first step in terms of getting access to US markets, sponsored 1 level ADRs make sense. And with the introduction of the unsponsored DR regime by the government, I think it's more sensible for companies to go for sponsored ADRs and have control over it, rather than being forced by the investors with an unsponsored DR program.
And that's exactly what Axis Bank, Bharti Infratel and Bharti Airtel have decided to do. In March, Axis Bank said its board had approved a sponsored level 1 depository receipt issuance program of up to 142 million DRs with a conversion of 5 equity shares to 1 DR. Managing Director and CEO Shikha Sharma said the bank had chosen to take the sponsored route so that the bank could have a more controlled program for the issue of ADRs. Last month, Bharti Infratel approved the establishment of a sponsored level 1 ADR program in the US. Chairman Akhil Gupta said the purpose is clearly not for capital raising, but to develop a new investor base, enhance investor service in the US, broaden the choices of available investment instruments, and gain greater name recognition across global investors. This week, Bharti Airtel's board approved the establishment of a sponsored level 1 ADR program.
So the way it works is that, many companies are very happy if the stock were just to be made available to overseas investors to trade once this level 1 DR route goes live. Because they just want to see investor demand, they want to test the waters, and they just want to make sure that there is, the stock is available. So for companies like that, the level 1 unsponsored route is a great option because the company doesn't have to do anything. There are multiple banks. As long as there is overseas investor demand, the level 1 unsponsored route will start trading on its own. So I think it's a great route for those kind of companies. On the other hand, there are also some companies which go a step ahead of that and say that they want to play a more active role in this whole ADR level 1 structure. And an active role can mean multiple things for them. One is having a level of control over the program, what's the program size and so on. The second is having a sharper and a more well-defined IR, investor relations strategy. So these are companies for whom if there are multiple banks, the investor relations strategy can become difficult to manage and they would instead want to have one single bank doing that. Finally, there will be some companies for whom eventually the goal is to convert to a full-fledged level 3 ADR program. For those kind of companies, if at inception your ADR program starts off in a sponsored structure where there's just one bank running with the entire program, the final conversion to a level 3 is much more simpler. So those are some of the key reasons which companies factor in while deciding whether to go in for a sponsored program.
So now there are a slew of filings for unsponsored ADRs and at least 3 sponsored ADRs in the works. But it's not clear when any of them will take off because 8 months after the depository receipt scheme was notified, companies and shareholders are still awaiting regulatory and tax clarifications.
From a regulation point of view, I think the industry is working with both RBI and SEBI. I think fundamentally the main thing is around the headroom monitoring process. So be it a sponsored DR program or an unsponsored level 1, the exact mechanism by which the foreign ownership limit availability will get disseminated to the market, that is what the headroom is all about, and that's what we are awaiting. And then there are some operational clarifications around reporting methodology and so on and so forth. But that I think is secondary.
With respect to tax, the key concern is only around, which is common for both sponsored and unsponsored, would be the fact that both transfer from non-resident to resident has a tax of about 10%, capital gains tax. And the conversion of DRs to shares currently don't have an express exemption. So our committee had highlighted these and suggested that these be clarified, but it's still not being done.
When these hurdles are overcome, the sponsored and unsponsored ADRs will list on the US OTC or over-the-counter market. Now, the OTC marketplaces trade over 1,600 ADRs from over 30 countries, with the total trading volume hitting $133 billion last year.
OTC Markets Group actually operates all off-exchange equity trading in the U.S. And we do that through 3 marketplaces. So we have our OTCQX, or what we call our best marketplace, which is where you'll find many of the blue chip ADRs, such as Roche and Adidas. We operate OTCQB, which is a venture stage marketplace for early stage and developing companies. And we operate the OTC Pink marketplace. That's a marketplace, we call it the open marketplace, for all types of equities, whether they be distressed or bankrupt, right up through to many of the unsponsored ADRs.
Jason, as I understand it, in the case of an unsponsored ADR, the issuer is not involved and doesn't have to make any additional disclosures or register with the SEC, right?
Right. So from the legal point of view, in I think it was October 2008, the rule which you referenced, 12G32B, was changed, and basically it was changed to allow for these unsponsored ADRs. The rule states that so long as a company is providing the disclosure that they're required to provide to their home market regulator in English on a public site, exempts them from SEC registration, so long as their operations are in another country and most of their businesses in that country. So from an Indian company perspective, there's no real added risk associated with an unsponsored ADR from an SEC perspective. So having to be worried about whether or not they'll have to be SEC registrants doesn't really exist. So that's a good thing. What you do need to think about if you're an Indian company is the level of control that you want to have over that vehicle. So in the unsponsored world, you could have up to 4 banks that have created an ADR program for you, and you really don't have any control from an issuer perspective over how you engage your investors and reach those investors. So whether it's corporate actions processing and how that gets distributed to your U.S. investors, how dividends get paid, the fees associated with the ADR program, all of those things in an unsponsored world you don't have control over, which is why we think it's the sponsored, which is really what Indian companies should be looking at.
Can you give us some detail on trading volumes for sponsored as well as unsponsored ADRs on the OTC marketplaces, and also what impact these ADRs have on home market volumes?
So OTCQX tends to trade about 4 times better than OTC Pink. Now obviously that's over all types of ADR programs, whether they're sponsored or unsponsored. On the Pink marketplace, I don't have the exact statistics, but you'll find that sponsored programs do tend to trade better than unsponsors. And again, that's a function of the company taking ownership of the program and being engaged with their investors. Our programs range, though, and a lot of that depends on investor demand. You'll find a lot of unsponsors that don't trade at all, but you will find some where there's significant investor interest where those trades or where those programs trade more. In the ADR world generally, and again, 76 countries have level 1 ADR programs, you will find that the majority of the trading is always going to be in the home market. So some of the best blue chip OTCQX ADRs, names like Roche and Adidas and Danone, if they can get to 10 to 15% of their global trading volume in the ADR, that's considered a successful ADR program.
I do want to ask you about the profile of investors trading on the OTC markets.
The investors that you'll find on the OTC markets, whether it's OTCQX or Pink, really are the same investors you would find anywhere else. The largest holders of ADRs, whether those are sponsored or unsponsored, actually happen to be the largest holder of international equities. So names like Fidelity and Capital and Janus actually have large portions of their international holdings in ADRs.
Okay, my final question, Jason. Do you think that the India opportunity is a big one for OTC markets?
This is actually, well, I can't put an exact number on it. I think BNY Mellon has put numbers in the billions. I certainly know that it is a big opportunity. India is a very difficult market for U.S. investors to transact in. It's costly, A. B, it's outside of time zones. And so there's always a home market bias when you come to trading. So to be able to trade in your time zones, in your currency, to have dividends and corporate actions in a way that you understand is really a great opportunity for Indian companies to expand their shareholder base, but also for many of the institutions that already trade in India or hold their equities to just make it more cost effective and easier for them. So I think the first big opportunity is you'll find a lot of holders of Indian equities now will seek to convert those positions to ADRs just to make it a little easier and to save some cost. And then what you'll do is certainly you'll open up India to that second, third tier institution and the retail investor that's wanted access to the country but really hasn't had the wherewithal to be able to invest, whether it's from a time zone or cost perspective.
All right, Jason, we'll leave it there. Thank you very much for joining us. We'll be keeping an eye on all the ADR announcements right here on the firm. But for now, it's time to say goodbye. We'll see you next week.
The Firm, India's only show on corporate law, tax and audit matters.